On March 3, 2023 in New York City, a subtle but consequential change was made within the trading infrastructure of Fintech Corp, a leading financial technology company specializing in automated trading systems. Fintech Corp had established itself as a prominent player in the markets, relying heavily on complex algorithms to execute trades across numerous exchanges. These algorithms, designed to optimize trading strategies and minimize human error, processed thousands of transactions per second, facilitating an efficient flow of capital. In a routine update meant to enhance trading speed, an engineer modified the code of one of the company's flagship trading algorithms. This update was intended to streamline order execution by increasing the trading volume capacity from 10,000 to 20,000 trades per second. However, during this process, a slight programming error was introduced, where a critical variable that controlled the algorithm's risk parameters was inadvertently left unset. This misconfiguration went unnoticed during initial testing due to inadequate logging practices, which failed to capture the error adequately. Internal tooling that was supposed to validate code changes also lacked stringent checks to flag this specific oversight. As the algorithms deployed the changes, they began to execute trades with increased volume but outside of normal risk boundaries. The result was a sudden surge in trading activity, far beyond the typical patterns observed by market analysts. Within minutes of the update, the system's functionality began to degrade, leading to unanticipated orders flooding multiple exchanges. The automated trading algorithms connected to Fintech Corp's systems dispersed millions of dollars worth of trades, resulting in a drastic fluctuation of stock prices for numerous companies. By the end of the trading day, the value of technology stocks listed on the NASDAQ dropped by an average of 12%, amounting to losses estimated at $350 billion in market capitalization. Internally, the responses to the unfolding situation were marked by confusion. Employees began reporting issues with the trading systems through the company's incident channel. Internal emails circulated detailing the sudden spikes in trading volume, prompting urgent discussions among operations teams and algorithm developers. Some suggested that external market conditions were to blame, while others focused on the recent code update that had gone live. Management quickly convened an emergency meeting, recognizing a need for immediate troubleshooting. But efforts to implement partial fixes were hampered by differing assumptions about the root cause of the spike. Externally, the effects of the algorithm's failure became evident as users began experiencing significant delays in order confirmations and cancellations. Customers took to social media to express frustrations about their inability to execute trades and the inaccuracies in price feeds they were receiving. Monitoring systems within Fintech Corp triggered alerts, indicating abnormal trading volumes and price movements. Minor media coverage hinted at market disturbances linked to Fintech Corp's trading activity, although the scale of the issue was not yet fully understood. As the hours progressed, it became clear that the problem was not isolated. Other financial institutions connected to Fintech Corp's trading algorithms reported similar anomalies. Their systems struggled to interpret the incoming data flood, which inadvertently set off a series of cascading failures. Interest rates and commodity futures also experienced volatility as financial models reacted to the chaotic market conditions. The interconnectedness of modern financial systems began to reveal its profound vulnerabilities. In-house teams tasked with monitoring trading performance worked frantically to identify and rectify the problem, but found themselves overwhelmed by the extent of the disruptions. Technical leads debated whether to roll back the recent updates or implement emergency patches. Meanwhile, customer service lines saw increased traffic as traders sought answers and reassurance. The initial confusion soon mutated into heightened anxiety among the organization's staff, who feared the implications of a market crash. As rumors of the algorithmic failure reached Wall Street, traders sensed a looming crisis, and the atmosphere of uncertainty intensified. By late afternoon, the fear of further destabilization extended beyond the confines of Fintech Corp's immediate operations. Other trading firms, recognizing a potential systemic risk, began to place their trades cautiously, further escalating the volatility in the market. It was at this juncture that industry analysts began to question the resilience of automated trading environments, as the conditions pointed toward an impending crisis. Despite the attempts to regain normalcy, the repercussions from the flawed algorithm continued to unfold, straining Fintech Corp's reputation and relationship with partners and brokerages. Regulatory bodies, monitoring the sudden market fluctuations, started to signal their concern, hinting at investigations into the mechanisms that governed algorithmic trading across financial platforms. The stage was set for a deeper examination of the vulnerability embedded in today's trading practices, with lasting implications for the financial sector and its stakeholders. As the day closed, the financial landscape remained uncertain, and the ramifications of that one code change loomed large, impeding any hopeful resolutions. The focus turned to recovery measures, though it was apparent that the fallout had only just begun. The following day began with urgent communications among senior management at Fintech Corp. An incident response team was formed to investigate the algorithm's performance, while external stakeholders scrambled to understand the full scope of the effect. Simultaneously, affected trading firms began issuing public statements regarding the disruptions, and many paused their algorithmic trading activities to assess the risks involved. Key partners raised their concerns about ongoing trades and demand for transparency regarding operational decisions made on the previous day. As the miscommunication among teams persisted, further complications arose. On the third day, executives decided to halt algorithmic trading entirely to regain control and prevent additional market disruptions. However, this decision led to missed trading opportunities, exacerbating customer dissatisfaction and prompting immediate backlash from affected users. Simultaneously, further volatility in the stock market continued, showcasing the cascading effects of lost trust among investors. Meanwhile, regulatory bodies like the SEC and CFTC began opening inquiries into the incident, signaling that they would be examining past communications, algorithm outputs, and code changes that were implemented. Legal teams from multiple involved firms commenced internal audits, gathering documentation in preparation for forthcoming regulatory requests. In the ensuing weeks, the media began to unravel the sequence of events through investigative reporting. Leaked internal communications shed light on the troubled code update, revealing that it had previously flagged multiple warnings about potential performance issues. Journalists uncovered a substantial volume of chat logs where engineers had discussed the speed of deployment, indicating an overriding pressure to release updates quickly without thorough testing. The findings pointed to a culture prioritizing rapid deployment over risk assessment, further exposing systemic failures in oversight mechanisms. By the end of the month, Fintech Corp faced accumulating pressures. Customers began filing class action lawsuits, citing financial losses due to the erroneous algorithm-induced trades. Concurrently, the company announced a hiring freeze and planned layoffs to manage financial repercussions, bringing additional scrutiny to its operational sustainability. As regulatory investigations progressed, potential fines loomed large on the horizon. Desperate to stabilize, Fintech Corp's executives announced an extensive overhaul of their automated trading protocols, pledging enhanced testing procedures and improved oversight. However, the bad press accelerated the diminishing public trust in their operations. Third-party vendor relationships frayed, and partners began reconsidering their reliance on Fintech Corp's technology, many seeking alternative solutions. Over the next several months, the fallout escalated further. Key investor confidence faltered, leading to a significant decline in stock prices for Fintech Corp as they faced mounting pressures from all fronts. The company reported losses of over $100 million in the first quarter post-incident, forcing it to contemplate divestitures of parts of its business. Regulatory oversight tightened across the sector, leading to newly implemented constraints within algorithmic trading strategies across all market participants. By the conclusion of the 6-month review, Fintech Corp was forced to acknowledge that the market disruption had irreversibly damaged its reputation. The culmination of regulatory findings resulted in heavy fines, but more importantly, it highlighted internal systemic failures that were deeply embedded. With board members being held accountable and some resigning as a result, the company's leadership undergoes significant restructuring, aiming for compliance while rebuilding market trust. Ultimately, the fallout led to Fintech Corp's decision to pivot towards a more conservative approach, shifting strategies with more focus on transparency and risk management. They publicly committed to fostering a culture of safety over speed, marking a stark shift in operational philosophy in an attempt to regain credibility. As of now, Fintech Corp operates under the stricter guidelines established by regulatory agencies, having made necessary adjustments to its trading strategies. The market's regulatory landscape has shifted considerably, preventing similar incidents in the near future. As of October 2023, Fintech Corp has maintained operations, though its reputation remains under scrutiny, with the memory of the algorithmic failures still echoing throughout the financial sector.